All right. Why don't we start the conversation, Phil? And let's start it off how we almost always start it off. Let's begin with some points of gratitude. What can we be grateful for as we get started here?
Yeah. Well, I can tell you, I was out last night and there was a huge storm just south of us. And I was watching the thunder and the lightning, or I was listening to the thunder, watching the lightning. And it was super dark. It's a new day, even after the worst of storms. And so I was very thankful for that reminder this morning and last night, this morning. So even in storms that we face in life, there's always a bright tomorrow. So that's what I was thankful for today.
Good call. Good call. Once again, it seems like the common theme, but I am thankful for everybody's health, family and friends included. Health is a big issue right now, but going into this webinar, what I am thankful for is that our company and our team in particular have been accustomed to the technological way of doing business for quite some time now, which has allowed us to be fluid. And when it was time to pivot, we didn't have very far to pivot. This atmosphere that we're working in right now is something we're very comfortable with. So I'm thankful for that. And hopefully that, that will serve us well in the future. I'm sure of that. So there's our points of gratitude. As a reminder, all of you should have access to the chat window. So when you have questions, please feel free to throw them in the chat window. And at the end of the presentation, we will definitely get to your questions. For those of you that don't know us, I'm Jeff McIntyre. I am the team leader for the Jeff McIntyre Group at eXp Realty. And we have Phil's going to run our presentation today. Phil Hadley is our expert buyer specialist with our team at the Jeff McIntyre Group.
Right on.
So Phil will get us started.
Yeah, just you mentioned the chat box for the questions. We'll get to those at the end of the presentation. And then just kind of a preface to the whole presentation and the conversation for today. We're not going to try to give any predictions on the severity of the virus or even talk too much about our own opinions of the virus. That's not our wheelhouse. We're going to keep it to real estate and projections and predictions for real estate, how that affects us. As far as the virus is concerned with our operations, we have always followed safety protocols in our business, and we will continue to do so. And which is why we're at home doing video conferences, because we can't go out and about. So this is for the safety of our families, friends, and clients, but it's also for your education, that we can help you to see how this is going to affect you and your real estate needs and the market coming down into the future.
Yeah, so as Phil mentioned, we're not going to be talking much about the virus itself, but what we are going to share is some historical data that shows that the housing and mortgage industries may not be hit quite as hard as we think right now. Most of you or some of you know that Fannie Mae sets the standard for mortgage qualifications and lending. And pretty much all the programs all across the board end up in one way or another conforming to Fannie Mae standards. There's actually been talk for years about abolishing or getting rid of Fannie Mae, and which could possibly also either strengthen other government programs or run them out also. So something interesting to watch in the future, but they are government funded loans, and it's something locally in mid-Michigan we need to keep our eye on, because it is a big part of our market. A lot of our buyers are using government-backed programs.
Yep. So it's not unreasonable to think that at a very minimum, that if the lending criteria tightens up enough to reduce the risk on their own, and we're seeing that right now, that minimum credit scores are coming up, so that the lending criteria is tightening, but as a basic rule of thumb, 640 and above would still be a safe credit score moving into the future, even with some changes coming to the mortgage market.
Mhm.
Right. So as we begin the presentation, one of the biggest factors in the home affordability is interest rate. And this chart here is the 30-year conventional mortgage interest rates over the last 20 years. What you see on the chart is different things, 9/11s there, SARS, the H1N1. And what it shows is the change in the mortgage interest rates over those years. And COVID-19 is different from 9/11, SARS, and the swine flu. Although the swine flu had 60 million people that were infected, and we don't believe we'll be anywhere near 60 million by the time COVID-19 is in the rearview mirror. But what we can see from this chart is that rates have dropped after every pandemic, including even 9/11 there. You can see, so that's kind of a good trend to keep in mind as we move forward.
Absolutely. So these are from the National Association of Realtors, starting with annual existing home sales. You'll notice that there was a climb in sales actually after 9/11, and actually through the SARS epidemic, and they only dropped through and to kick off the mortgage crisis, and they finally bottomed out nationally anyway, right around 2008. So I say nationally only because I believe locally we lag behind a little bit from the national trends. So we may have been able to say that we probably bottomed out late 2009, early 2010 here in mid Michigan.
Mhm. And what you can see is that after these non-housing related national and global pandemics or epidemics, there was no huge drop off in home sales. And we will see a drop off perhaps like on a quarterly scale or even through the rest of this year. But the forces that drive home sales are still at play. People still have reasons to buy, they still have reasons to sell, even in the midst of times like this: job transfers, marriages, divorces, growing families, aging, etc. These things are all still happening, and so people are always going to have a reason to buy and sell. And despite the bleak circumstances, it's not related to um, the factors of why people buy and sell houses. And I think the biggest point to make there is that the prices don't necessarily fall because there's a pandemic occurring.
Absolutely.
So the stock market reaction to previous viruses, you can see the reaction there. The stock market definitely reacts adversely to pandemics, and we know this to be true. The stock market's based on perception, or at least a lot of it is. And you can see how far the markets fell during the previous pandemics. At one point, in this coronavirus pandemic, the stock market was down. I think the number was 37%, which is a lot. But we've already seen some recovery to that loss. And the market is such a fluid and live animal. It fluctuates by the minute. So we're not going to try to tell you where it's at right now, where it's going to be at in 12 hours from now or in 12 months from now. We're not even going to address that. The stock market does not react favorably to global pandemics. But we also know, you can look at this, and we know that the government has passed stimulus packages. And there might be another one in the future to help spur the economy and to bring that back. So those things are going to help the stock market and help the economy. But it's important to understand that the stock market and the housing market are two separate things. And we'll get to that as we go through this presentation. The stock market for sure reacts adversely to global pandemics.
So what we're looking at here, primarily, a lot of people, especially those that were adults and young adults through the mortgage crisis, are going to be inclined to try to compare this to that crisis. So when we look at this chart, the mortgage credit availability index just shows how much credit was being extended and was available during the mortgage crisis. And you can see that it was basically easy to get a mortgage. And I can recall anecdotal stories, having conversations with friends saying, "Oh my gosh, I can't believe I got approved, for this much," and that was kind of the conversation back then. So they're very loose with lending criteria during the mortgage crisis. In fact, really, when you compare these numbers to today, they were actually about 8.5 times as loose as they are right now with lending criteria, if that converts and makes sense to you. Um, and the thing to note there is that there's a reason that bubble had burst. First of all, it became a bubble. It got so out of hand, and money was way too easy for people to get their hands on. And as this chart shows, that is not the case today. We talked earlier about lending criteria tightening up, and it's been that way, since the mortgage crisis. So that I believe is a very good thing.
It is. And just to clarify on this graph, the higher that number is, the easier it is to obtain a mortgage. So the lower the number, the harder it is to get a mortgage. So you can see how high that number was back in the mortgage crisis, how easy it was to get a mortgage. And now you can see how that number has leveled out a little bit and stayed low relative to where it was over the past 7, even up to 10 years. It's been much more responsible with the lending availability.
Absolutely. Yep. So now it really comes down to you have to have a reasonable income, reasonable
Mhm.
credit score, 640 or above. And the debt to income ratio is something that's talked about often and is a major player in qualification um, for mortgages. So basically, now people have more staying power than they did in the past, meaning that their finances are much better order than they were for the typical home buyer or for many home buyers during the mortgage crisis.
So let's look at the percent of median income needed to purchase a medium priced home. So we're talking about not averages so much as middle of the road income versus middle of the road pricing for a house. And what we see is that people are spending less of a percentage on their income on their housing. So this just means that where they could be, or that there could be a bit more of a cushion because people are spending less of that percentage. So we're assuming that since they're spending less of their income on their housing, that they have more of a cushion on the other end.
Yeah, I actually read a stat from Freddie Mac that supports this whole thing. In reference to home equity loans, the average American homeowner is not currently using their home like a piggy bank, like they did back in the mortgage crisis. In 2006, there were $321 billion of home equity loans borrowed against people's homes. So it's 321 billion. In 2018, there was $87 billion in home equity loans drawn. So nearly a quarter, less than a quarter of what was during the mortgage crisis. So um, people should be in more equitable positions than they were back then. So if there was a crash, um, your home's equity should be able to save you from things like foreclosure, um,
Mhm.
medical bills, bankruptcies. It just bottom line, like you said, Phil, there's just more of a cushion there for the typical homeowner now than there was back then. So inventory is a if you've listened to me talk at all about the state of the market, pretty much since I've been in the business for 16 years now, you've heard me discuss listing inventory. And why would I talk so much about listing inventory? Well, it really comes down to the idea that the number of homes available for sale drive the status of the market or the state of the market. In 2007, we had a surplus of homes available on the market. In fact, I dug back and we actually had typically we had just over 8 months worth of inventory, meaning that, from this day forward, if there was not another property listed for sale, we could last 8 months on the available inventory before we ran completely out. That is the definition of a buyer's market. And if you recall that market, we definitely called it a buyer's market. 4 to 5 months of inventory is considered a balanced market. And right now, and certainly over the last several years, we have been sitting at about 3 months of inventory available. Um, and locally, I would make the argument there were times where we were definitely less than 3 months. This, without question, means we're in a seller's market. And in order to get to a buyer's market, not that we want to be, but to get to a buyer's market, um, there'd have to be a pretty drastic change in available inventory, and demand. Demand is high right now. So this by itself should play a part in keeping prices, or at least minimize any price drops that we may see as a result of this.
So here you see the annual home price appreciation. This slide almost speaks for itself in terms of comparing where we were leading up to the housing crash of 2006 to 2008 versus the last 6 year period. You can see that the high point there for the 6 years leading up to the crash was 12 and a half. The lowest was 6.5. And you can see that our highest over the last 6 years hasn't even reached the lowest point that it was during those 6 years leading up to the crash. So you can see that the home price appreciation has dropped and stayed at a lower level consistently. And so what that tells us, let me just go back to this slide real quick because it's very important to notice. What this tells us is that there is no, or there is not a bubble of pricing. Um, you can see that the prices have stayed more consistent, so they haven't spiked up. So there is no bubble that's going to burst in the housing market.
Yeah, and I think that's important for people to turn around and be able to convey to other people in conversation about the real estate market in particular, um, is that no, the bubble's not going to burst because we're just not at bubble levels. We're just not.
Right.
So here, there's a couple of things to note. The S&P correction during the most recent crisis was about 51%. While during that same time, home price depreciation nationally took about a 20% hit. So a 50% loss in the stock market does not equal a 50% loss in home values. So in other words, stock market corrections and home values are not dependent on each other, not directly related as far as percentages.
So some lead economists are saying that this pandemic's impact on the economy is very similar to that of 9/11 with the fear of subsequent terrorist attacks. People were afraid to go to large venues and travel by air, etc., things like that. So the travel and the hospitality industries are what's taking the biggest hit. And those are the same industries that took the biggest hit in 9/11, and we're seeing that on the news today. Those are the places that are being shut down, non-essential places like that are taking the economic hit. So that's why the economists are relating what we're going through now more so to 9/11 than to SARS or the swine flu. So now we're looking at the .com and the 9/11 crash. What you see is the stock market correction was at about a 50% loss. Again, while this time we say an annual home appreciation rate averaged almost 8%. So that's an increase in home values at the time that the stock market was losing 50%. So that again points out the fact that these two things are not related. The stock market and home values are not related. Um, they're two different markets. And while the stock market was losing 50%, we see that home values were consistently 6.5 and above.
So really, all of this is to come around to the point that a recession does not equal a housing crisis. It just doesn't.
Mhm. Bill McBride of Calculated Risk, he suggests here in this quote that while we are in a recession, the rebound is going to be determined by the length of time we are on lockdown due to the pandemic. So obviously, the shorter time we're on lockdown, the quicker and better we'll rebound. The longer we're on lockdown and the longer this prolongs, then the slower the rebound is going to occur.
And I'm going to interrupt real quick there, Phil, and point out I was talking to our good friend Charles Dahl of Metro Mortgage, our preferred lending partner, and he wanted to point out that a recession is defined by 2 quarters consecutively with a loss. And while it's possible that we could see 2 quarters in a row, we haven't yet. We haven't yet.
Right.
So even defining us as a recession right now is a little premature.
And we'll see that when we come to our next slide here. Um, the Goldman Sachs, the Goldman Sachs predicted, or this is their prediction for the market, the 2020 quarterly prediction here. And what we see is that they predict that the third and fourth quarters of this year, we will actually see a rebound. And if you compare that to their prediction for the first and second quarter, it's almost going to break even, not quite. It'll be a little bit of a loss. But you can see the difference in their March 15th forecast and versus their March 20th forecast. And obviously, the pandemic was announced in between those two dates. So you can see the change that that had on the prediction of the market. But if you look at the third and fourth quarter, it does give us that good perspective moving forward that there is a rebound that's going to come, and it will almost balance things out for what we're facing here in the second quarter.
So Wells Fargo, arguably one of the larger lending institutions in the country, and also one of the lending institutions that probably you could say took a huge hit during the mortgage crisis. And then you could probably also argue that they may have benefited the most from the mortgage crisis, but that's probably a topic for another conversation. But regardless, they're in the thick of it, and they don't see the severity of this recession equal to that of the mortgage crisis. So they just from their position, they don't see it happening. And so during the last 5 recessions, this is a quick look at the home prices during those recessions. And the 2008, as a reminder, that was a recession that was directly caused by the mortgage industry and frankly, irresponsible lending and guidelines that were just out of control and too loose. Um, so and then it's just important to note that the 4 previous recessions were not caused by the housing industry. Um, so harkening back to the mortgage crisis, one of the looming issues that are out there that could seriously have a negative impact on any housing market, but ours in particular, is foreclosures.
Mhm.
And if we were to see a boom of foreclosures, it would certainly drive prices down. We know that.
Right.
The economic stimulus package, in combination with some moratoriums, some policies on foreclosures and evictions, are designed to curb those foreclosures. The jury, let's face it, is still out as to whether a moratorium actually serves that cause to make a major impact or curb foreclosures. But nonetheless, those are the policies that are in place to try to curb it.
So aside from home values, the number one factor of home affordability for buyers is the mortgage interest rate. So what you can see from this chart here is that mortgage interest rates are still historically incredibly low. You can see the different types of mortgages. They're represented by the different lines. The story is basically the same with them all at different levels, but they're all historically low. And I think that's important to realize. They've continued to drop even after crises. They will continue or most likely stay that way while the Federal Reserve continues to work with the consumer to stimulate the economy. So the rates, you can expect to see them to stay low so that the economy can bounce back, so the consumer can get involved again with the economy.
Yeah, and the thing I'd like to remind people in this one is that back during the mortgage crisis, we were operating at historically low mortgage rates then. We were chirping about 7%. We were in that 7% range. I remember during the um, first time homebuyer credit, which was another stimulus package to try to keep people buying homes. Yeah, 7.75 jumps out at me as, or low sevens anyway, it jumps out at me as people flocking to their lender to get pre-approved, and those that were working consistently and had solid work were more than happy to take a 7% mortgage. And now we're talking in the fours, and this is it's a pretty live animal as well, very fluid, but definitely in the fours and possibly as high as the upper fours, but still incredibly low. So borrowing money to buy a home is more affordable than it's ever been. And in our view, based on all this information, it doesn't seem to be changing drastically anytime soon. So our message is, if you are able, this is an incredible time to be buying a home, which in turn also means it's an incredible time to be selling a home. That's the bottom line. That's kind of our deduction after all this research, Phil, is that while things are certainly uncertain in the world right now as far as public health, and then we have to be concerned about employment for folks, and that's the reality of it. But those that are able in a position to, it's now is the time for sure. So that concludes all the information we have. I don't see any questions in the chat box at this time. If I could, well, I can't, there we go. Nope, no questions. So we will take a recording of this and make it available for those that fell asleep during the presentation, or lost interest and grabbed lunch or went out and sat in the sun and had us on while they're listening. We will offer a recording, and we probably will also offer a second version of this while we look into any changes that might take place in these predictions, or any new data comes out that changes
For sure.
the projections for sure. So thank you everybody for attending. We appreciate it. Thank you, Phil, for running a nice presentation.
Yeah. Thank you guys for joining us.
Have a great sunny Wednesday afternoon, everybody.
All right. We'll see you.